I would like to encourage folks to, please interrupt me at any given time and ask questions, because I know as a person in the audience, it's much more interesting when we've got a dialogue going. There it is. There, okay. Okay, so just a little bit about RBC, my new Wall Street home for the last 10 years, or 11 years, I guess, at this point. RBC Capital Markets is a subsidiary of the Royal Bank of Canada, based in Toronto, although RBC Capital Markets, our home office is based in New York City. Revenue of $6.9 billion. They cover all sorts of, capital markets, insurance, wealth management, personal commercial banking, investor and treasury services. Our global footprint, we do have offices, obviously in Canada, the United States, in Europe, Hong Kong, Australia, Mumbai, Singapore. So we are a global company, and the United States is really about a third or more of the employees are based in the U.S. So the U.S. has been a very big expansion area for RBC. One thing we take pride in is our reputation and high ethical standards, which was extremely important to me. I want to work for a corporation that, always tells the truth and always advises clients on what is best for them rather than, what may make the most in fees. So this is a nice title that we were voted the #1 trusted investment bank by Economist magazine, and #2 in expertise and skills. And it's kind of hard for you guys to see this map, but it has high trust and high expertise in the right quadrant, and we are at the top there, whereas the other quadrants have low trust, low expertise, etc. So that means a lot to us. RBC is the 16th safest bank in the world, and while that sounds great, maybe not as impressive, why are you touting 16? Well, there's no U.S. banks on this list, and the only other North American bank is TD Bank in Canada. All the others are, Europe, Singapore, Australia. So that's quite good, and many times we've been voted the #1 safest in North America. Although I think we may have dropped this last year.
But just during for example, I guess that's substantial, like during the financial crisis.
Yes.
Very good
point.
You need a lot of inroads in the area when you had a strong balance sheet where other firms were not able to do business or shedding business because there's other capital.
That's an excellent point. That after the financial crisis, U.S. banks took a hit. Canada has a different approach. For example, to residential loans, everyone puts 20% down for a mortgage in Canada. And I don't know, things might have changed a little bit. That's something I heard a number of years ago. But they also don't believe in 30-year fixed rate. That's part of our very core for mortgages here in the U.S., but often they vary the interest rate every 5 years to reduce their risk. So Canadian banks came out quite well in 2008. And RBC in particular used that opportunity to recruit a number of high-quality bankers from firms that were shedding, as Dr. Brown said. And in particular, in my area, in the housing group, UBS, Union Bank of Switzerland, had actually shut down their municipal practice and fired everyone, basically. And if you think about it, like, they probably could have sold this unit. They were number one in municipal finance. They had a lot of talented bankers, but one reason they were number one is they didn't really care about the bottom line, were they making money or not. You can actually be number one and making it up in volume and on competitive sales where you take no fee and you're taking risk. So they did a lot of competitive sales, and they also hired huge staffs, and they paid them all bonus based on, like, if 5 people worked on a transaction, they'd pay them 5 times. And I don't think that the math on that works very well, you know, if you don't conduct yourself like a business. So that's what happens when people don't, they let everyone go. And so we hired 5 people in their housing group. And today we're number one in housing. So, we did take advantage of that. Have you all heard of the book Flash Boys? Anybody read it? I have to say I haven't read it. I need to read it. Well, and so you know then that I guess he was the hero in RBC Capital Markets trader, Brad. What was, say it again? Yeah, thank you. So he discovered the front running that was going on with trades when he was trying to input trades on behalf of his customers, figured it out, and then created a software system to equalize that problem. And I think that evidences, you know, what I was saying previously about ethical standards, that a lot of, you know, and of course every company has outliers and not everyone, you know, is perfect. But RBC definitely has a culture of having a high ethical standard, doing the right thing for your clients and doing the right thing, you know, for your colleagues. And being, like, every year we have a respectful workplace training, you know, where it really makes you think about, you know, different situations, how you would act, and, you know, how you can be a better employee. So I like that. Another, well, and I'll get to that in a minute, never mind. So our top capabilities, we're the fastest growing top 10 investment bank. We have a full suite of products and services with the highest level of expertise, safest and most trusted bank. That's all on the capabilities side, but we still maintain a boutique environment with lean deal terms, flat organization, and focus on community. And the flat organization, you know, I didn't really appreciate that was a positive thing until I thought about UBS and how, you know, they had this municipal finance group. They were number one in the U.S. and they scuttled it because it wasn't making any money. Well, the people in Switzerland didn't really know what was going on in the U.S. and they weren't looking at the revenues, and when they figured it out, you know, they shut it down. But at RBC, you know, the top, you know, the president of RBC Capital Markets knows very much what is going on in municipal finance in the U.S. And they are very involved when we make credit decisions. There are people, representatives in Toronto, who are on the phone, who vote yay or nay on approving a credit. And I view that as very positive because they're part of the process. And if there's a problem with that credit at some point, you know, they participated in the decision and they know what the strengths and weaknesses were. So that's my little diatribe on flat. We give back to the community. There was recently an RBC Blue Water project committing $50 million to organizations worldwide. And that program is pretty much fully subscribed at this point. Recently, they committed another $100 million to kids programs where different nonprofits can apply for funding from across the globe. And just there's been a lot going on in New York City as well. So a very philanthropic and good neighbor. And here in Florida, we didn't want to let time go by and let that Blue Water Grant, be spent in full without getting something here in Florida. So we worked with a couple of nonprofits to submit grant applications, and we're so pleased that RBC funded $100,000 to the Everglades Foundation and also the Legacy Institute for Nature and Culture, a $25,000 grant. Our municipal finance department, which is what I am a part of, it's actually the largest municipal markets operation in the U.S. We have more employees in our municipal finance group than any other firm. And I think that is in part because we come from a regional culture. RBC first became active in the municipal finance area when they acquired Dane Rauscher, which was a regional firm. Dane Bosworth was in the Minnesota area, Northwest, and Rauscher Pierce Refnes in the Southwest. So acquired this regional firm, that was two separate regional firms put together. Then RBC acquired Sutro in California, Tucker Anthony in the Northeast, and William R. Huff and Company was the missing link in the Southeast. So we have regional roots at RBC, and we've found that works extremely well with municipal finance because we're close to our clients. We're not flying from New York to California to call on someone for a water and sewer deal. They're our neighbors, and it allows us to get to know our clients better because we live in their communities. And we have a variety of core sectors: healthcare, higher education, housing, K through 12 education and charter schools, public power, special districts, student loans, and transportation. And so we have 332 employees right now. And we're ranked number 5 in the country. And you know how I talked about, I keep using UPS. Oh, hey. Yeah.
Were you worried that when you said it was like this regional field, that when you were acquired by a Wall Street company over 10, 11 years ago, were you worried that the culture would change, that they would try and funnel all the municipal business out of like New York, or were you kind of comfortable that you would be able to everyone would stay in Florida, and the operations wouldn't be too impacted?
I'll say yes and no on that. And I had the really good fortune. My brother was the president of the company at the time. My father was chairman of the board. And my brother included me in the discussions with RBC. Capital Markets at that time was based in, the U.S. portion was based in Minneapolis, because that's where Dane Rauscher had been based. And I think any time there's an acquisition, you're very worried about those types of things. But I think we felt on the municipal finance side, the investment banking side, we felt very comfortable that they wanted us to retain our Florida offices because they came from regional roots as well, and they believed in that model, working closely in close geographic proximity to your clients. But where the worry was, and well-founded, was, I guess, on the trading side, operations and underwriting. We thought we were going to be keeping our underwriting desk, and that didn't happen. And really, eventually, all of our sales and trading either went to New York or no longer was in St. Pete, and our operations as well, because you have one operation system. So that was a very difficult part of the transition. But on the banking side, I would say it was quite seamless. And so I think we're happy in our number 5 slot. We might rather be 4th or maybe 3rd. But our manager says, you know what, I don't want to be 1st or 2nd, because those who are in the number 1, number 2 slot are bidding heavily on competitive sales. There's like no spread in them, and there's tremendous risk. So, you know, do you really want to do something just for rankings? And RBC does not. That's not what we want to do. We don't want to be flashy and say, you know, we want to do things because they make business sense and they create revenue and minimize risk.
I mean, if I elaborate on that, if I do the math in my head, what stands out is that for the total par amount that you underwrite in a year, you do a lot of deals.
We do.
So you do smaller, that are non-competitive, sort of probably captured customers, probably higher spread, higher profit margin, know them well, as opposed to the monstrous deals that make big money.
Exactly, and thank you for pointing that out, because until there was a Stifel Nicholas recently acquired a firm, and they underwrote more deals than we have, but every other year I think we underwrote more deals than any other firm, and it's like a 2-to-1 ratio for the top, as you can see. We underwrite twice as many deals, which is another reason our desk does not want to do competitive deals, because they're busy, you know, working deals that are negotiated where we're engaged as a senior manager, and we want to do a great job for our clients that hired us. We're not going to sacrifice and, you know, with the competitive deals. That's a great point. Oh, and our ratings. We're the highest rated bank in North America, or an institution engaged in the municipal marketplace. So our ratings are AA3, AA minus, AA. And Wells Fargo is next with AA3, AA minus, AA minus. So, you know, that has been a great story, particularly following the financial meltdown. So this is our footprint, where you can see we've got a lot of municipal offices, 27 office locations in 17 states, which is, you know, again, reflective of our regional roots. We're not flying in from New York to call in our clients. Okay, here we are with the trading desk. Did you all see Wall Street, Money Never Sleeps? So this was the trading floor on that movie. So if you want to see our trading floor, go rent or whatever you do, download from Hulu or whatever it is, Wall Street, Money Never Sleeps. And the reason that they chose RBC's trading floor is twofold. Number one, it was new, you know, brand new with 700 Bloombergs. But number two, they approached folks like Goldman or Citi, and this was filming right around the financial meltdown. And those folks, I don't think they wanted to raise their profile in that fashion, because they were very sensitive of the accusations, you know, perhaps as part of the financial woes that we were feeling. And RBC had nothing to, you know, nobody was talking about RBC in connection with the financial meltdown. So we obviously do engage in underwriting and trading, and have a massive desk there in New York. We do have wealth management. In terms of distribution capabilities, RBC Wealth Management has over 1,870 financial consultants. We have institutional accounts and different correspondents, so we have a strong distribution capability. We have a strong presence in Florida. We're currently ranked number 3. You know, things shift around a lot. I'm not sure if that's where we'll end up, but we've had quite a nice year. We've worked with some very large issuers such as Greater Orlando Aviation Authority, Miami Airport, Tampa Airport, Jacksonville Electric Authority, and Florida Housing, which is my account. This was an article in the Bond Buyer just noting RBC's growth in the municipal space. And just the fact that our negotiated issuance by par jumped 37% from 2008 to 2012. And probably the more telling fact was that 8 of the other top 10 underwriters saw decreases of as much as 41% during that time. So that just kind of shows our growth.
Can you give a short primer? I mean, I know the difference, but not most people are probably going between a competitive and a negotiated deal.
Oh,
Can you just
sure.
go into more?
Competitive transactions is just like what it sounds. An issuer with their financial advisor will create an offering document for a financing, for a municipal bond offering. And then they will post that offering document and invite underwriters to bid on their bonds. And so it's a competitive sale where, you know, underwriters will form what they call syndicates, you know, groups of underwriters, or they'll bid alone, and they'll bid a yield on that bond, or what they will pay a price for the bonds, and whoever pays the highest price is awarded the transaction. But from our standpoint, it's a difficult thing to do because frequently you don't have enough time to market that bond issue to end clients. And so if you don't have that opportunity and it takes a long time, then you're at risk, you know, that you'll be holding bonds and the market moves away from you and you can lose money. So, so that's, from the issuer standpoint, they like it because they think if people are competing, they'll get a better price. But sometimes it doesn't work out that way in markets where there's a lot of volatility. You know, an underwriter may not bid as aggressively because they don't have time to market it, you know, to all the end investors. So they may, you know, be hesitant. And that happened a lot right after 2008 when market conditions were rough. A negotiated issue, on the other hand, is where an issuer chooses an underwriter to senior manage their financing, and they choose a team of underwriters to sell their bonds. So you negotiate, you know, with this underwriting team, and then the underwriting team has an order period, and they set a price for the bonds, and they offer them out to investors. And then they can adjust the price. You know, if they get a lot of orders, they may reduce the rate and in that fashion.
Yeah, but in a negotiated, you have a fee.
Right, correct.
And so most negotiated deals will be relatively small municipalities in relation to major cities and big states. You know, hundreds of $1 billion issues would be competitive.
Yeah, it kind of, you know, sometimes they can be negotiated if they're very large. It just, I guess it depends on the nature of the deal. If they're very short-term bonds, that tends to be competitive. I guess it just depends, but we like it when they're negotiated. RBC does offer balance sheet products to our clients, and our current portfolio has grown from $1 billion in 2005 to $14.8 billion. And this has been very important because many times issuers will award business to firms that provide them with credit or balance sheet lending products. And we have special products that reduce the cost of borrowing for them. So that's important in serving larger issuers like the city of New York or state of California. And these are some of our balance sheet clients.
So that was following on Michael's question earlier, is that would be the one potential obvious benefit from the old environmental authorities?
Absolutely, yeah. That is a big benefit over a regional firm that doesn't have that capability, because it really allows you to have more high-profile clients, larger transactions. So now we're on my favorite part, housing. In the housing area, mortgage revenue bonds are the type of bonds that we issue, and it's a type of bond that's allowable under the tax code. And mortgage revenue bonds are issued by state or local housing finance authorities. And they can be used to fund either single-family programs or multi-family programs. And single-family addresses first-time home buyers and provides them with favorable mortgage financing so that it's easier for them to buy a house. And multifamily funds apartments for lower income households. And also in the multifamily sector, there's something called the low-income housing tax credit, which serves as a subsidy or an equity to raise money to help build these multifamily projects, which are going to serve low-income households. And in the state of Florida, we have the Florida Housing Finance Corporation. That's our state housing agency. We also have many local housing finance authorities as well. They're in every major county, large county in the state, and certain medium counties. So I kind of provided an example here. You guys are here in Gainesville, and what it means when we're serving lower income households. On the multifamily projects, they generally serve folks at or below 60% of area median income. It's going to be different for every county in the state, but based on Gainesville's median income, this would serve someone who earns $38,280 or less. And if the target was 50% of AMI, it's $31,900 or less. So, that's still a decent salary, for someone. So these apartments house, teachers, workforce folks, police, fire, and they also provide services, as I'll show later. On the single family side, the bonds are designed to help. In Gainesville, a family of one or two would have income at or below $63,800, or a family of three or more, $73,370. And those who are not first-time home buyers, veterans, you don't have to be a first-time home buyer, for example.
So just because I get it, for the city of Gainesville, for example, or Alachua County, if they want to build multifamily for low income, they're not going to wait till tax receipts or something pile up until they have $1 billion. So they're going to go out and borrow money. And then,
right, using tax exempt
bonds. The
bonds.
payments from this and
right.
And the revenues from the city, and then you would come in and help them structure the nature of the bond and then sell it.
Right. The housing bond for multifamily, the revenues from the project, the rents, are really what's going to secure the bonds. And so you have to pro forma, project out what the rental income will be, what the expenses are, how many bonds or debt, how much debt can be supported. Then you have tax credit equity coming in. A large institution will buy tax credits, and that comprises about 30% of the project cost. And you still probably may need some other form of subsidy financing, which we'll get to, where the state has subsidy funds that they make available for this purpose.
I hate to be selfish, but I never understood that. I think I do now. So if I build this, someone builds this, then there are property tax credits generated. And so someone can come in and those tax credits accrue to the project. But someone can come in and buy those tax credits as an asset.
Right.
And then so then you monetize that today, and that's sort of part of the equity.
Yeah, and it's federal low-income housing tax credit is the program, so it's a federal program. So Publix or city or some insurance company, may say, hey, I want to buy some of these tax credits to reduce our federal income taxes corporately, and so I'm going to pay you, let's say the project cost is $10 million, I'm going to pay you $3 million to buy your tax credits. And so then the developer uses that $3 million to help build the project. And so it's an amazing program that's been around since the Tax Act of '86, I believe. And it's grown quite a bit, and people advocate highly for it in Washington. So RBC's housing experience, this is last year's ranking, and again this year we're ranked number 1 in the country. So it was kind of a long road. I think we were, 8th or something, a number of years ago, but we kept adding bankers. We got the UBS bankers, my favorite firm to, and we kept adding some other bankers and came up with innovations, really. And we're number 3 when we add in the multifamily.
So on the deals that are here, how much?
And these are all single-family deals.
Right, and these single-family deals here, how much of that of expertise, pick one in Massachusetts housing? How much expertise is sort of Massachusetts specific? How much of it is housing? So in other words, for you, being the housing person, are you touching all these deals, or are you more focused on the Southeast?
I'm more focused on the Southeast.
Because there are nuances in that market.
Yeah, but I would say 95% is housing. Like, but there, maybe 95, maybe 80% housing, 20%. Because you really need to understand the policies of the state housing agency. It's not like you need to have that much knowledge about the state itself, but yeah. And that might even, I don't know, that's a hard.
Yeah, no. But
You definitely need to know your client, because the clients are achieving their goals so many different ways these days. So I don't want to underscore how important it is to know the client. But I guess I'm also underscoring what a specialty sector housing is. Like, if you asked me about water and sewer deals, I could tell you very little. Because my world is housing, although I manage our Florida office, so I get involved in a shallow level. I'm going to skip over. This is just what our different, we've got 14 bankers in housing. We do have a tax credit equity firm that employs 81 professionals. So RBC, the tax credits we were talking about, RBC buys those.
How much of the 7.8% market share that RBC has in munis is attributed from the housing sector?
Oh, that's a great question. And I don't know the answer.
Does the housing sector make up a big branch of?
I mean, it's significant, but I don't. I'm gonna say it wouldn't be more than 15% or something. I don't think. But I guess we could do the math. Do we want to do it? 1.2. 1.2 billion out of 18 billion.
Not like 15%?
Or not quite, 8% maybe? 1.2 out of 18?
Yeah.
Okay.
Alex, you have a question?
Yeah, how much of the revenue that is coming in from like the, I guess the South specifically, is from developers coming back to RBC and re-raising debt for a new project, or is a lot of the revenue driven just from new developers, new projects, or whatever?
That's a good question, and we do have a lot of repeat business. Like there's one group, the Cornerstone Group, that we're working on a transaction with right now, and we worked with them first in like 1996, and we financed a lot of their transactions, just a lot. We've been working with Related, some of you might have heard of Related. They're a big developer based in New York and Miami, and we've worked on a lot of repeat transactions with them, which has been really exciting. There's another product that I'll talk about at the very end that we innovated. It was the first of its kind. It was a type of a Fannie Mae bond that resembled a mortgage-backed security pass-through that they wanted to be the first, and so that was really cool. But we also get introduced to a lot of new developers, which is nice. So I think we've developed quite a reputation. There's not a lot of folks focusing on multifamily the way we do, and I think that we do a better job than other firms, if I do say so myself. And so I think clients, developers are referred to us a lot. Yeah.
And then, not really a follow-up, but another question. So in order to get the tax credit, you need that 40% and the 60%. As far as just a regular, like, multifamily bond, how would, I'm trying to rephrase this well. Like if there's a development, 'cause I was just reading about the Crystal Lake for Pompano. With that, can you have covenants in the bond when you're underwriting it that say how many low income or very low income there will be before it's issued, or is that just kind of
Yes.
as it becomes filled and as happens met?
No, absolutely, there are covenants, and there's something called a land use restriction agreement that specifies exactly the percentage of units that are targeted to each area median income group. And to qualify for tax credits, they just have to target 60%. But there are some programs where some governmental agency may give subsidy if they target 10% at 40% of AMI, because they feel like there's a greater need and the rent will be lower, for that class of people. And all of that information is included in this, they call it a LURA, Land Use Restriction Agreement, which is recorded with the mortgage on the property. So the developer has to abide by that, and if they don't, they're in default and can be foreclosed. And the rents, it's not just enough to restrict the units, the rents are restricted too. So, they can't just say, oh, you qualify, come in, I'm going to charge you $1,200 a month. It's a capped rent. And it's a formula on how much they're allowed to pay. Great question. I think that's good on this slide. So on balance sheet, we were talking about credit. We've also used that in the housing sector. We've used $1.2 billion of RBC's balance sheet supporting state housing finance agency transactions, and these have been focused on the single family area. Our tax credit equity group, this is a map showing all of the tax credit developments and how many units they have been involved with over the years. They've raised $5.7 billion since they were created in 1997. They were also an acquisition. Just like William R. Huff and Company, they were, Apollo was the name. And in Florida, we've created 3,284 units in 24 properties with equity of $229 million. And one thing with multifamily that we are always pitching is that it's a job driver. It creates jobs. And so we rely on funding, like either from the federal government in the form of the tax credit program, and rely on that program, continuing, but also on state housing trust funds is a form of subsidy. So we always have to tell the story of we're not only serving folks, but we're also creating jobs.
Are you guys involved in rehab re-syndications where people come in after the 15 years, or are you guys just doing new developments? Like, are you doing 4%,
Yes.
9%?
You must know what you're talking about, yes. We do both new syndication and re-syndication. Our Florida housing practice, this is the practice in which I am involved. Since January 1, 2010, we have underwritten $535 million and 39 bond issues. And this is a smaller number than it would have been many years ago, because we've been involved with a lot of private placements and also selling directly mortgage-backed securities. So our volume has dropped, but our activity is still very robust, and I'll explain that a little bit more later. But we have 3 full-time housing bankers, myself, my colleague Debbie Berner, and John Sabache, who are all based in St. Pete. And we've been active since around 1980. And because we've been active since 1980, this is the reason why our market share is so great at 44%. We know the clients very well. We know the developers very well. We're very active in the developer coalitions. And so we know so much about our business, it's a little difficult. Other firms just don't have that same expertise. So we're able to provide a better level of service. These are logos of our Housing Finance Authority clients, and we are a senior manager for every large county issuer in the state of Florida. Jacksonville, Orlando, Miami-Dade, Broward, Palm Beach, Hillsborough, Pinellas, as well as some others, and Florida Housing, the state. Okay, when we talk about affordable housing, you may think slums, or hopefully you don't think of that, but these are actually tax credit, photos of real tax credit developments. The very colorful one is in Miami-Dade, the high-rise in an urban setting, and different garden communities, but these communities have been very successful, and their residents very fortunate. And I think the most important thing about the multifamily projects are some of the services that they provide. For family projects, almost all or most of the projects provide after-school programs for kids. So you can imagine, just how difficult that is with 2 working parents. You're a single parent. What are you going to do for your child after school? They can take the bus and have a safe place to go and do their homework or activities. The same with senior. There's some developments for seniors, and they have organized activities and certain services they provide as well. I mentioned subsidy. We have our tax credits, which we talked about, and tax-exempt bonds that form the capital stack to build a multifamily project. But for a new construction project, that's not enough. We need what we call gap financing, or a subsidy to help pay the remainder of the cost to develop the project. And a number of years ago, the Sadowski Act was passed, creating a housing trust fund. And this fund this year would amount to $323 million. This last year, we were funded to the tune of $170 million, And if we would have been funded the entire amount, it would have been a lot more. But the legislature recently has chosen not to fund our trust funds. Like in 2008, they completely swept our trust funds for several years, and that made it more difficult to produce housing. Fortunately, during that time, the federal government, because of our financial woes, had given the housing agencies resources, so it didn't hurt as much because we had other resources coming in. But after that funding dried up, it was very important. And so we as an entire industry have had to become active in lobbying or educating our legislature about the benefits of affordable housing. And so, for example, if this $323 million was funded, they calculate that it would create 32,000 jobs and have an economic impact of $4.6 billion. Yes?
How does this type of funding impact the use of, I know from Florida, it's called like the hardest hit foreclosure fund?
Oh, okay. Well, they're two separate programs. The hardest hit is, that is a federal funding to help people help people avoid foreclosure. And what the state housing trust funds do two things. Number one, they provide money to the Florida Housing Finance Corporation for multifamily development to help provide gap funding for these multifamily tax credit projects. But then another portion of it goes to every local government in the state of Florida. And each local government is allowed to use it as they see fit. Like there are certain parameters, like 65% needs to be used for home ownership, but they can use it for rental or any number of different approaches.
On the multifamily side, would you say like apartment complexes are constructed with the intent of being a affordable housing place, or would you say it's like already built apartment complexes that decide, hey, let's transition into an affordable housing area?
Well, you can do either with the following caveat. Many times there are new developments targeted at affordable. But someone could buy an existing apartment complex. It has to be an acquisition. Someone who currently owns a project can't just decide, I want to make it. But if they sell it, they could get tax credits, and you can do acquisition rehabilitation. So that is an approach. Yes?
How do students play into that? Like, say a Gainesville, you're building an apartment complex, having 100% students would most likely mean they're under the income line. Does that not qualify?
Yeah, sadly, the federal government in their infinite wisdom excluded students from the affordable housing, this type of housing. Yeah.
How sensitive is your business to the amount of these tax subsidies and incentives from the government? Like if they decided to slash those incentives by half for whatever legislative reason, would your business be affected?
Yeah, we do have volume ups and downs, and we've gone through those, and our, the production ebbs and flows, and our revenues ebb and flow. But fortunately, like I've been doing this since like 1988, or I'm getting old. I'm just going on 30 years, and there's always, I don't know, there's been enough to do. So luckily, the affordable housing lobby is very strong. So like, for example, for the tax credit program, every once in a while, someone will have a great idea to overhaul the tax code, and they'll say, let's scrap this program. But so far, we've been able to educate our legislators what these programs do. And it was very, it's very helpful to have the investors, we have huge financial institutions investing in these tax credits. So there's, there's a lot of advocates out there, not just developers. It's developers, state and local housing finance agencies, the institutions that buy tax credits, the industry professionals like us. So we do, and we have a great story to tell. So yes, we are, we would be heard if they, did certain things, but so far, we've weathered the storm. Did I miss anyone?
I had a quick one on commercial real estate. For multifamily, perhaps there would be, some construction or development financing. It would be short-term, permanent financing would be put on when it's stabilized. This break all from the beginning.
Right. We are.
And this is equity, not interim bridge financing.
Right, the housing trust fund money is kind of a permanent loan, but at a rate like 0% or 1%. So it'll be a loan that the state housing trust funds make to the development, but it won't have any principal repayment and maybe like 1%.
And then another quick question on the buyers of the ultimate paper. Are these structures preferred by some segment of the or generic?
Yes, one group of buyers of the tax exempt bonds for affordable housing developments is banks. Our big buyers, Citi, Wells Fargo, JP Morgan Chase. They are, I don't know if you all have ever heard of the Community Reinvestment Act, but that's an act that encourages and requires banks to loan money to lower income communities. Like, in other words, they don't want banks just making all the loans to $1 million households in a community. They want them to serve, the entire community. And so they have to prove every 3 years that they are lending to lower income neighborhoods. So they develop, programs to buy the bonds. And that could have been, and I'm going to talk about this later, a death knell for us because we're an underwriter of bonds. We're used to taking a bond issue and marketing it to all kinds of different investors. But we've kind of found a niche to be what we call a placement agent and kind of facilitate the transaction, assist the developer, assist the issuer, and earn some revenue from that. Yes?
With the interest rate and cap rate environment, have you seen general partners getting out of these deals earlier than normal? Like buying up LPs and getting out? Has that been a trend that you've seen going forward?
Yes. There are, various developers. And this program is designed for all of you. It's a 15-year period, like a 15-year compliance period, and then it extends to 30 years. But most developers are looking at these transactions as a 15-year transaction. And so the question is, are any of the developers wanting to get out before year 15? And yes, because I think there's become quite a liquid market. There have been investors who are actively looking for those kind of transactions to buy, and especially in this extremely competitive environment right now where multifamily properties are so desired and are selling for kind of record amounts. If someone can buy a property that is somewhat tied up until year 15, they may be able to get kind of a discount or something. So yes, we've seen that happen. Okay, client solutions. So this was my favorite slide. Adapt or die. I didn't want to write the word die though. There are question marks. So we got dinosaurs on the left, and we have the result of those who adapted on the right. If you saw Jurassic Park, they kind of through that analogy. And so a case for client solutions. So what I mean by that is, you know, we kind of had the rug pulled out from under us in the municipal market, the tax exempt market. And, you know, things have changed. And this graph illustrates the red line is the 10-year treasury. The 10-year treasury is a taxable rate. And the blue line is the AAA Municipal Market Data Index, which is a tax-exempt rate. You can see in 2005 to 2008 that the tax-exempt rates were lower than the taxable treasury rate. That's how it's supposed to be, right? I mean, if you're buying a bond, which would you rather buy? I'll take the one that you don't have to pay income tax on, right? Well, after 2008, the liquidity changed a lot, and then there was a flight to quality with the U.S. Treasury. And so we kind of had a mismatch where the tax-exempt bond rates were higher than the taxable bond rates. And I'll just give you an example. It used to be, you know, if we had a Ginnie Mae mortgage-backed security backing a tax-exempt bond issue, it used to be that rate would be a lot lower than the rate on just a plain Ginnie Mae security that's taxable. But if we would have sold it at this time, the MBS would have had a lower yield, even though it's taxable. And part of that was due to quantitative easing, where the Treasury was buying lots and lots of MBS securities and Treasury bonds. So they were a natural demand, and the yields dropped, and our global crisis caused flight to quality. So just all the metrics were odd. And so our volume of issuance, these were housing bonds. It's kind of a complicated chart to see, but you get the gist of the trend. In 2006 and 2007, the housing market had 17 billion, in issuance, and today we're at 2 billion. That's year to date. I'm going to say we're going to be, closer to 3 by the end of the year. So, it's just a different world today. But, things are going to normalize, and part of that is the low interest rate environment we have. As interest rates rise, it would follow that tax-exempt income would be more valuable. And that's kind of traditional with the housing market. We in the housing market tend to be more busy when rates are higher because there's a greater advantage for our tax-exempt debt. Okay,
So just so I wasn't clear, I've always wondered, I understand the financial crisis. I understand why the market tax rates were negative when that actually graph. I also would have guessed what you said to make sure I have it right. Nowadays, financial crisis in the rear view mirror, there's still limited liquidity and also an absolute low rate environment because people aren't going to buy municipals through treasury.
Right.
And the marginal tax rate.
Right, like retail right now.
Yeah, who's going to buy it?
Yeah, like, do you want a 30-year 3% bond
Right.
or something?
And even though it's a better deal than treasury, the fact that it's 3% doesn't matter.
Right.
It's off the table.
Right. Another phenomenon of the financial crisis, for geeky people that might find this interesting, is that it used to be before the crisis, there were so many bonds that were insured. There were several bond insurers, MBIA, FIDGIT, FSA. Well, they all were kind of doing side deals with the MBS, crazy stuff, and they kind of imploded and their credit quality deteriorated significantly. So investors, if you think about it from an institutional investor standpoint, they used to look at the insurance and say, okay, I'll buy that. That's an easy one to understand. I'm buying the AAA insured bond. Well, now all the analysts are having to look through the insurance because the insurance isn't worth anything and figure out what's the underlying security. And then you have to kind of understand, what is this municipality, what's their budget like, and, it's just a lot harder to analyze. And so as a result, a lot of the new deals are coming uninsured. So we have a lot more A-rated bonds, AA rated, and it's also given rise to more bank loan activity. Because the banks want to lend right now. They may not want to lend to residential loans, and they love lending to municipalities because the credit quality's strong. So it's just kind of interesting.
And so that story part of the graph you just showed, and it's sort of today's AAAs are not viewed as pristine as the old ones that were insured.
Right.
Because that graph was AAAs.
Right.
But this is not quite your father's AAA.
Right, right, exactly. I think I've already talked about that. Okay, so we have all this challenge, so what do we do? On the Housing Finance Authority front with single family, we don't have as much interest rate advantage anymore. We're going to rely more on down payment assistance. And that's a great approach, because we may be giving home buyers $10,000 of down payment assistance with a 0% rate, and the loan is deferred until they refinance or sell the property. But we either need subsidy to fund the down payment assistance, or the Housing Finance Agency has to use their own money. And they don't have money, to do that forever. So that's a good thing, but, a limited positive. We innovated, and RBC was a leader in this, in the single family market, and why we're ranked #1 today. We redesigned the tax exempt bond. We know that people are buying mortgage-backed securities, Fannie Mae, Freddie Mac, Ginnie Mae. They're buying them like crazy, and the yields are very low, like 3%. And so we said, why in the world can't we structure the bond to look like a mortgage-backed security? And the mortgage-backed security will actually be the security for the bond. And, why wouldn't someone want that at least at the same rate as an MBS? And so we structured it that way. We structured the bond, usually bonds have semi-annual payments and different serials and terms. This was one single bond, monthly payment. The entire mortgage-backed security payment gets passed through to the bondholder. We just dumbed it down, simplified it, and it worked because we achieved interest rate savings. It's ranged from 50 to 100 basis points, a half a point to 1% lower interest rate than our traditional structures. So that was a win-win.
So it would be more liquid because this is one issue instead of all the different maturities.
Yes.
It seems much more liquid.
Yes,
Yeah.
exactly. And we kind of pulled in the taxable buyers.
Right.
They're like,
I know this thing.
yeah, exactly. And then for our smaller issuers, we looked to the taxable market and conventional lending market and said, well, how are conventional lenders financing their mortgage loans? Well, they use what's called the TBA market. And yes, that's to be announced is what that means. And it allowed our local issuers to originate one loan at a time rather than taking the risk of paying costs on a $10 million bond issue. So we've developed a program with 7 of our local HFA clients, and we've executed 250 trades through RBC's trading desk. This is another differentiation. If we were William R. Huff and Company, we would not have had this resource. And we've sold over $175 million in loans under this program. And as much as it was important for us to earn revenue on this, it was really more important for our Housing Finance Authority clients to stay active, because if they leave the market, it's very difficult to attract lender partners again. So it was a win-win. This is about the pass-through market. We've done about $1 billion in single-family pass-through bonds to date, and we are the leader in that. We were the first ones to, structure it, and for our $1 billion, the next largest volume was 422. So we've had quite success. On the TBA market, I put this slide in. Basically TBA is a forward sale. If you have a loan reservation, you can sell that loan 60 to 90 days out and lock in the pricing. Because otherwise, if lenders make mortgage loans and they wait till the loan originates to sell it, that's huge market exposure. So the TBA market was designed in the 1970s to really facilitate home ownership and support the government-sponsored enterprises, Fannie, Freddie, and Ginnie, to help people manage their interest rate risk. But I thought this was an interesting slide. The far right is the volume of municipal bonds. The far left is the volume of treasuries. This is trading volume in 1 quarter. This is an old slide, it's 2011, so it's old. But it just gives you the, the difference between, and then agency MBS is second to the left, what the volume of mortgage-backed securities is in comparison to something like municipal debt and corporate debt, for that matter. So it's a huge market. On the multifamily front, I already mentioned bonds. Banks are buying a lot of tax-exempt bonds. There's also a structure that was created because traditional lending, taxable lending, Fannie Mae, Freddie Mac, Ginnie Mae, the rates were so low, we could not replicate those rates in the tax-exempt market for multifamily projects. Yet there's a problem. The developer cannot get the low-income housing tax credit unless they issue tax-exempt bonds. So we've started issuing tax-exempt bonds for like a 1.5-year period, for a very short period of time, and they're backed by cash or a treasury, and so they had a very low interest rate, maybe 0.5% is the interest rate, and so the developer had to pay double costs on 2 different financings, this cash-backed short bond, and then they had their permanent financing as a Fannie Mae, Freddie Mac, or Ginnie Mae. But they did this in order to qualify for the 4% tax credit, which gives them 30% of their project cost. So that was kind of an innovation or approach that is taken since 2008. And lastly, I mentioned we mimicked the pass-through bond that we had done in the single-family market. We applied that to the multifamily market, and we achieved interest rate savings. We're guessing 25 basis points. It's not as great as in the taxable market, but it's still, savings, and we did that with related affordable. This slide just illustrates, I mentioned that because so many of the bonds are being purchased by banks, that could have been a bad situation for us because we typically underwrite bonds and we typically handle, selling the bond issue. But in this case, we've adapted to serving as a placement agent. Our fee is lower, but our services are less. But we really assist the developer in getting the transaction closed. And it works for them. They're happy to have our assistance. And so we've done 39 transactions totaling over $500 million in the last 5 years, taking that approach. I already talked about. And this is the inaugural multifamily pass-through bond that we just did a case study slide on it. It sold at a rate of 3% for a 16-year maturity, and it was done in Illinois. So that was fun to work on a first. I always like when we are able to be innovative. It's exciting. Yes?
Are these new types of bonds being purchased primarily by depositories, or have you seen other people getting them?
This particular transaction there were 7 investors. We had a couple that were motivated by that Community Reinvestment Act, so they were financial institutions that needed to lend, in affordable housing. We had some insurance companies and money managers. I would say, banks, insurance companies, and money managers, that's kind of the typical buyer for our housing bonds. Does that answer? So that's,
Anybody else have any questions? Thank you very much.